Although the market traded off heavily today, the Dow down 177, it didn't change the upward trajectory of the market. We're still above the T-line. Remember, the T-line is very effective. It's not like a major moving average like the 50-day simple moving average or the 200-day moving average, which are on every major money manager's chart analysis. Those moving averages act like magnets because everybody's watching them. The effectiveness of the T-line is based upon just natural investor sentiment, support, and resistance. Because nobody has this on their charts, when you do put it on your chart, if you combine the effectiveness of candlestick analysis, which is the graphic depiction of human nature, and then you add the T-line, which acts like a natural support and resistance, or a Fibonacci type number, or support and resistance, when you combine those two, you've got a very powerful combination. The fact that the moving in or the markets did not close back below the T-line, let alone the 3T line, tells you that investor sentiment is still in a bullish direction. Knowing that, the backing and filling that we see occasionally in the markets, a couple of down days, tells us the profit taking is occurring along the way. This makes the lack of enthusiasm coming in the market or making the market trend much more solid. I say much more solid. This market's been heading up steadily now for the last 12 months, 15 months, ever since November of, not this past year, but the election time. That just tells us investor sentiment is remaining strong until we see a dramatic sell signal and a close back below the T-line. Understanding what investor sentiment is telling us, we can take advantage on charts like Netflix, which started off with a fry pan bottom, and then the big gap up, and then telling us we're still in an uptrend, still as a result of this fry pan bottom. We also know that as long as we're above the 3T line, let alone the T line, we're still in an uptrend. We have factors like the stochastics that tell us if we're in the overbought condition, even though we're in an uptrend, we should probably have safety stops. The Japanese rice traders utilize very simple logic for when to be in and out of a trade. So if you were long Netflix, you'd put your safety stop at today's open, because if it has enough strength to sell off through that level tomorrow, it's obvious that the bears are now in control. Recognizing the different patterns allows investors to take advantage of price moves as long as they're moving in the right direction. For example, when we saw that Amazon kind of broke out through this wedge pattern, there's our J-hook pattern. And what did the J-hook pattern pretty much tell us? They couldn't close below the T-line. The J-hook pattern tells us that if wave 1, if this is wave 1, wave 3 should be approximately the same area right up into this area. Knowing how human nature works time after time allows you as a candlestick investor to have a much more refined format and much greater probabilities of being in the right trades at the right time and staying in the correct trades until you can maximize your profits. That'll be it. We'll see you in the chat rooms.